This presentation is about the Report to Parliament, Results of Audit Local Government Entities for 2014-15. This report summarises the results of our financial statement audits of all entities in Queensland's local government sector for the last financial year. There were 155 entities in the sector that were required to prepare financial statements, including 77 councils and 78 local government entities. Each year, every Queensland public sector entity is subject to a financial audit. Our audits provide the users of financial statements with independent assurance that they are reliable and comply with prescribed requirements. We report on the audit opinions we have issued, significant financial reporting issues, the time taken by councils to prepare their financial statements, and the quality of the financial statements provided to us. We also report on the significant control issues that we have identified during our audits, as well as providing our assessment of each council's financial sustainability. As well as providing an audit opinion on the financial statements of councils, we also provide an opinion on their current year financial sustainability statement. It is important to note that our opinion on the current year financial sustainability statement only relates to whether the three legislated financial sustainability ratios have been accurately calculated. We do not form an opinion on the appropriateness or relevance of the reported ratios, nor on a council's future sustainability. 4 councils and 6 related entities received a qualified audit opinion on their 2014-15 financial statements. This means that 93% of the entities in the sector received an unmodified audit opinion, which indicates that their financial statements were prepared in accordance with legislation and the relevant accounting standards. While this is a good result, there are still 4 council audits and 1 council-related entity audit still in progress at the time of this report. Unfinished audits regularly indicate issues that translate into qualified opinions. Of the 8 councils whose 2013-14 financial statements were unfinished at this time last year, 3 of those received qualified opinions. This year, for the second time, we have included in our report an assessment of each council's financial governance. This is in the form of a traffic light report. The assessment covered the timeliness of financial reporting, the quality of statements provided to audit, the number of significant control issues it raised, and our assessment of the council's financial sustainability. A red traffic light means the council has missed the legislated financial reporting deadline, provided poor quality financial statements to us, had more than 5 significant control issues raised by us during the audit, or been assessed as being at a higher risk of becoming unsustainable. Our assessments of the individual councils by name are included in Appendix H of our report. 25 councils received a red traffic light across the financial governance categories. 9 councils received more than 1 red traffic light. While this is an improvement from the prior year, red traffic lights require immediate action and indicate significant concerns for these councils' control environments and public reporting. This year, the timeliness of financial reporting by Queensland councils has significantly improved. 88% of councils met the financial reporting deadline. This is the best result in the history of local government financial reporting in Queensland. But this timeline is still behind other states. As previously mentioned, 4 council audits are still unfinalised. For these councils, and one other untimely council, their annual reports were not available in time for their communities to assess their council's performance prior to the recent Queensland local government elections. This significantly diminishes the value of their annual reporting. 4 councils have not met the financial reporting deadline for 4 consecutive years. This is a poor reflection on these councils' ability to prioritise their financial reporting and act on our recommendations for improvement. We also reported on 3 significant financial reporting issues. Asset management planning is key to financial sustainability. Councils manage $77.6 billion in infrastructure, yet only 37% of their asset management plans are up to date. Asset management planning is essential for financial budgeting and ensuring that assets are appropriately maintained and replaced in order to deliver agreed service levels to the community. We recommend that councils give greater prioritisation to effective asset management. Council operations are also continually expanding. Councils provide a large and wide variety of services through their own internal business units or through separate controlled entities. Disclosure requirements in relation to business activities are complex and not well understood by councils. We recommend that councils make publicly available the financial statements of their controlled entities. Next year, councils will be required to disclose related party relationships and transactions in their annual financial statements. Related parties are likely to include the Mayor, councillors, Chief Executive Officers, and other senior executives, and any of their close family members, and any entities that they control. Any transactions between council and these parties, whether monetary or not, may need to be identified and disclosed. This is a step forward in accountability and transparency. However, there is a real risk that information needed for disclosures is not readily evident in council systems. While councils have started their assessments of their systems, policies and procedures, there is still a large body of work to be undertaken. We recommend that councils take immediate action. Across the sector, we have not observed any significant improvement in councils' internal control frameworks over the years. We consistently identify the same types of issues across the sector. 31% of issues raised in 2014-15 remain unresolved from the prior year. We identified 60 councils with significant control breakdowns, and 60% of the issues identified related to weaknesses in property, plant and equipment, expenditure and financial reporting. There is a direct link between the prevalence of audit issues and the stability of senior management. 71 CEO positions have changed across 56 councils since the 2012 local government elections. This is a turnover rate of 1.3 for those councils over the last term. 12 councils had, on average, 4.6 CEOs over the same period. The average turnover was highest in Indigenous and resource councils. These councils also have the highest percentage of significant control deficiencies. Effective controls need competent oversight. An effective audit committee provides councils with added confidence that the financial reporting and control frameworks are being effectively monitored. 38 councils were required to have an audit committee in place for the first time from 1 July 2014. The requirement to have an audit committee under local government legislation is linked to the categorisation of councils by the Remuneration and Discipline Tribunal. While these committees are still maturing, this is a positive step forward towards improved corporate governance. However, we note that the Tribunal has changed its categorisations, making audit committees optional for some councils. We recommend that audit committees be mandated for all councils. To be financially sustainable, councils need long-term planning processes that manage future risk while maintaining appropriate community service levels. On average, over the past 5 years, the local government sector as a whole spent more than it earned. If councils are to become and remain sustainable, they should be planning to at least break even over the longer term so they generate enough funds to maintain existing service levels and their current asset base. Operating surpluses will allow councils to invest in further infrastructure or expand into new services. All councils can presently service their financial liabilities. The fact that many are growing their net financial assets indicates that a number of councils are accumulating cash and investment reserves in preference to using debt to replace or expand their assets. While sector results for asset sustainability as a whole are positive, there are 19 councils with average asset sustainability ratios below the 90% target set by the Department of Infrastructure, Local Government and Planning. For these councils, a lower ratio could indicate that they are not replacing their assets as they are consumed, creating a future sustainability risk. Alternatively, in some cases, it may reflect newer asset bases as a result of responding to natural disasters, and therefore less need to renew assets early in their life cycles. We trust this presentation has been of value. The full report can be found on the Queensland Audit Office's website. Thank you.